All right, welcome to chapter two. So, chapter two deals with, and the most important part of this chapter that you'll be spending most of your time on is learning more details about the balance sheet. You were introduced to the balance sheet in chapter one as a general concept and as a general structure. But chapter two introduces you to a lot more detail because balance sheets are set up in a way that they're called classified balance sheets. So we're going to be spending our time learning about this today. Okay. So again, balance sheets are dated as of a particular day. Okay, like I was mentioning, they're sort of like financial selfies. Um, as of today, these are my assets, these are my liabilities, this is my stockholders' equity. As of today, it'll change tomorrow. It was different yesterday. So we have to label balance sheets by date because it's very specific to each day. Okay. And you already know in general that assets equals liabilities and stockholders' equity, sort of an equation. Assets equals liabilities plus stockholders' equity. And that's a very important equation to remember. Okay. But what you might not know is that there are lots of different types of assets. And so in accounting, they have used what they call classifications. They have basically classified different types of assets. And you see, there are four different classifications of assets. All of them are assets. It's just we standardize them by using classifications. Every company that you will see has something called current assets. The word current simply means these are assets that are going to be turned into cash very quickly, or they will be used up very quickly. And what we mean by very quickly is within a year. Okay, usually it's one operating cycle, but we'll just go with the year. Okay, so
Okay.
current assets, the word current in accounting simply represents a time period of less than a year. You'll also notice too that liabilities have an account classification also called current. So assets are the current assets are the ones we're going to be turning into cash or using up within a year. Current liabilities are those debts that we need to pay within this year. And I have a question here. Someone cannot hear me. Um, is that true for everyone, or can everyone else hear me? Yeah.
I can hear you.
Okay. So you might want to check that. I don't know why you can't hear me. Probably it's on your end. Um, so here we have current is one way to look at or how we classify things on the balance sheet. Okay, so the word current, look at current as the same as short term, as the same as it's going to happen within a year. Okay. Um, so again, our focus today, we're going to look at current assets in more detail. So current assets are going to be turned into cash or used up very quickly within 1 year. All the other assets are long term, and as you might think in accounting, it's really not that difficult. Current is short term or less than a year. So long term must be more than 1 year. And that's how we define it in accounting. So assets, these are resources that the business owns and will be using for longer than a year's period of time. So that could be literally a year and a half or 2 years, could literally be 20 or 30 years. And so any type of asset that the business owns that they're going to be using for anywhere of a period of over a year to upwards of 20 or 30 or years or more is considered long term. Um, the same in the liability category, the word long term liability simply means debts that are due over a year. And again, how do we measure this idea of current and long term is why we use the date on the balance sheet. Okay, that date on the balance sheet tells us what is current and what is long-term. Okay. So, for example, in the case of a current asset, these are assets that we're going to be using within a year from the point of time that you see on the balance sheet. So, if the balance sheet is dated today, February the 1st, 2021, a current asset is either going to be is an asset that we are going to either turn into cash or use within the year's period between now and February 1st, 2022. Okay. If it's an asset that we plan to use longer than that, it would be a long-term asset, long-term from the date on the balance sheet. So if, again, today's date is February the 1st, 2021. If I plan to use this asset for a period of longer than a year, it would be long-term. Okay. Um, Again, the liabilities are simple because they only use current or long-term. So a current liability is a debt that's due within the year from the point in time, the date on the balance sheet. Long-term liabilities are debts that are due past that date on the balance sheet. Okay. So the short-term, long-term is a very important aspect to know here. Short-term we call current in accounting. Long-term we do call long-term. However, as you see in the asset section, we have actually classified long-term assets in a few different ways, three to be exact. Let me start with the one that you're going to see on every balance sheet you will ever look at in your lifetime. Okay, and that is basically called property, plant, and equipment. Property, plant, and equipment is a very, very common asset that all businesses have. And you have to think about, in this case, what the terms mean. The terms are a little bit dated in some ways make perfect sense. Property is simply land, right? If a company owns land, land is going to be a long-term asset. It's going to be under property, plant, and equipment. Plant is an older term for buildings, factories, things like this. So if a company has buildings, or factories, in the case of manufacturing, they would be under plant from property, plant, and equipment. And equipment is a pretty broad term. It could mean something very technical like robotic equipment on an assembly line. It could also mean a truck or a car. If you have a delivery truck or you use a car to provide your services. It could also mean computer equipment, tables, chairs, other types of things that you have in your restaurant or in your office space. So equipment's a relatively broad type of category because a lot of things can fit into this idea of what is equipment. But the reason a company would buy equipment is because they plan to use that resource for a long period of time. So if I had my pizzeria, I certainly would have refrigeration equipment. I certainly would have ovens and stations that I need to do preparing. I also need to have tables and chairs for my customers to sit at. I need a display case and a cash register and things like that. All that would be equipment. It's a very, very large account. I might also have a delivery truck to deliver pizzas. That might also be under my equipment account. So it's a broad category and it's something that you have to know about. So every company you will look at in this class and out of this class will definitely have those two classifications of assets. Current assets, because all companies have cash and things that'll be turned into cash quickly. All companies have assets that they're going to use very, very quickly, like supplies and insurance. But then again, all companies will also have property, plant, and equipment. They may or may not have land. They may have or may not have buildings, but a lot of them do. And almost all companies, regardless where they have equipment. And so you will see these on every single balance sheet in your lifetime. The other classifications of assets are well, one of them is getting a lot more common. This one here, the intangible asset. An intangible asset is basically it's a paper that proves that you either own and created an invention. So if you have a patent, for example, patent, you have a patent, that is government recognition that you are the legal creator or inventor of something. Okay. And that could be a piece of equipment. Um, it could be a drug, or something like this. But it tends to be it's a product that you have created and or designed, and you own that. That's an intangible asset because technically it is simply a piece of paper that shows ownership. But with that piece of paper, it gives you exclusive rights to manufacture it. Only you can do it. Another thing that's important in business is copyrights. And a copyright, again, proves ownership of things that are either written or created, painted, or artistically designed. Software is also copywritten. Um, there are that's very, very important because companies like Microsoft or all of your gaming companies, they have copyrights to prove ownership of their games. And that copyright, that proof of ownership of their game that they created it, gives them the exclusive right to sell it. If anyone else tries to sell it without their permission, they can sue because they can prove in court they're the owners. And so that's also true in music and in movies and other types of things, video, audio, things like this. Very important to prove ownership. And it's the copyright that does so. And again, the copyright is also basically a piece of paper that, again, gives official government recognition of as you as the owner. That's true for books, that's true for music, it's true for artwork, it's true for software, etc. So that's a very, very important asset. Okay, because think of Microsoft wouldn't be Microsoft if it weren't for its copyrights. Because they have intangible assets, those copyrights on all their software, that's what makes Microsoft Microsoft, because that's basically how they get started. They started as a company just selling software. But without those copyrights, they wouldn't be where they are today. Um, Apple, just the opposite, they have a bunch of patents. They're creators of various things. It was an iPod, then an iPad, then a Mac, a Mac and a MacBook, and all different types of products from there. Those are based on patents. And so whether it's, those are intangible assets, and they're critically important to companies because that's particularly today, because that's how they make a living. Google exists on intangible assets, on their patents and copyrights. That's their entire business is based on that. So is Disney. So it's an important asset. We classify it because unlike property, plant, and equipment, which you can actually sit on the land or you can touch the buildings and you can use the equipment. Intangible assets are basically pieces of paper that prove ownership. They're extremely important pieces of paper because they have a legal clout, right? And so they matter. They matter a lot. But you can't touch them. They don't have any physical quality, so they're called an intangible asset. So more and more companies will have intangible assets, and they're classified differently because of that feature. Not a lot of companies have what we call the long-term investment, because most companies really can't afford to have a lot of them. So a long-term investment is an asset that the company owns for the long term, but they're not using them right now in their business. So here's an example. Remember my pizza shop. I might have a building, I might own my pizza shop. I have my land, my building, my equipment. All of that would be in my property, plant, and equipment. But let's say I wanted to expand. I'm doing really, really well in my pizza shop, and I wanted to put a new pizza shop, say down in the Newburgh area. And so I bought a building or I bought a piece of land that I will develop into my next pizza shop, say next year. I'm not doing it right now, but I own it. Well, that's a long-term investment because I do own the building or I do own the land. So it is my asset. But long-term investments are not used in generating revenue for the company. So I'm not using that land or that building to make pizza and sell my pizza. So it's not property, plant, and equipment. Property, plant, and equipment is used in doing what I'm doing right now. It's actively used in helping me sell my stuff. Long-term investments are not. I own them. I own them for the long term, but I'm not using them right now to sell my pizza, for example, in my pizzeria. So that's how we classify a long-term investment. Companies can also, because we're dealing with corporations also can purchase stock or other investments in other companies that they will hold for longer than a year. Now, clearly, companies can do that, but that's an asset for them. But it's not generating revenue for their main, operation. So the fact that Walmart uh, purchased stock in one of its suppliers and owns those shares of ownership, isn't contributing to Walmart selling any goods, which is what Walmart does. That's their business, selling goods. But they own it, but it's not directly related to them selling their goods. So that's what a long-term investment would be. That's what it would look like, both to my pizza shop, again, that land or building that I own, but I haven't developed it yet, so it's not selling any pizza for me, or big corporations like Walmart, which might buy stock in a company or a supplier and keep it for a while, but it's not generating any revenue for them. It's not generating sales of their products. They just own it. So those are the four classifications. Your book goes over them in more detail. And then your book also introduces you to more accounts. Okay, more accounts. Now remember, this is accounting. So in order to understand accounting, we have to understand these accounts. So you already have been introduced to cash. So you already know what cash is from the previous chapter. You've already been introduced to accounts receivable. You've already been introduced to supplies, and you've already been introduced to prepaid insurance, all from chapter 1. Okay. So you already know what those accounts are about. What you haven't been introduced to yet are the rest of them. Okay. So let's go over them. So a debt investment simply is very similar to, I would say, if you go to the bank and you have a bank account, that would be part of your cash, but you have a lot of extra money in that bank account that you want to invest short term. So you might purchase shares of a money market. You might purchase uh, another type of an instrument security that's part of the money market, like a treasury bill. That's a debt investment. You own it, but what you own is debt. What you own is you're a lender. A debt investment simply means you've made an investment as a lender, and so putting a big portion of your money in a money market is a lending activity, but you own it, so it's your debt investment. Giving a portion of your money to the government for short-term treasury bill, whether it's a month or 3 months or whatever, that's a debt investment. You own it, but you're lending your money as an investment. So it's a debt investment. A note receivable, you already know about the word note from liabilities. What you haven't seen the word note is as an asset. The interesting thing is a note receivable means that you made the loan. So some companies during business to business transactions will help their customer, which is another business, by the way, take a longer period of time to pay. Usually when you do business with a customer and you sell something to them and you give them an invoice, you're expecting them to pay within 30 days. That's an accounts receivable. You're waiting to receive the money within 30 days. But some businesses that you do business with might need longer than 30 days to pay you. And so they'll say, look, I really need longer than 30 days to pay this. And you say, fine, let's make it 60 days or 90 days or 120 days. but I will charge you interest. That's a note receivable. That's all. Nothing big, nothing too fancy. Didn't pull a rabbit out of my hat here. That's it. Just it's an accounts receivable that the person needs longer to pay. In other words, you need to wait to receive it for a longer period of time. And you've agreed to do that with an interest rate attached. So it became a loan. Note. Inventory, as you read about it in chapter 1 already. It's basically the goods that are purchased that are on the shelf waiting to be sold. Right. So if you walk into Walmart, you'll see a bunch of goods on their shelves waiting to be sold. That's their inventory. Okay. So these are all considered what we call current assets because they're either going to be turned into cash or used up. Cash is already cash. Debt investments can be turned into cash within 24 hours. Okay. Accounts receivable are you're waiting for cash. You're waiting to receive cash. You've already done the job. You're waiting to receive the cash payment on the job. Again, that's usually within 30 days. Notes receivable, again, are accounts receivable that need longer to pay. So you've made it into a loan. So you're waiting for the cash longer. This will be turned into cash in 60 days or 90 days or 120 days or whatever the agreement was. But it's going to be short. You're not going to wait too long for that. Inventory is going to be turned into cash once you sell the product on your shelf. But then inventory starts when we start expensing these things. After you sold inventory, it's going to be turned into cash, but now you can expense it as cost of goods sold. After you use up supplies, you can expense it as supplies expense. After you use up your insurance, you can expense it as insurance expense. So this is basically how current assets are broken. Okay. Let me go to property, plant, equipment because this is the most common one you're going to see. Every company is going to have current assets. Every company is going to have property, plant, equipment. So I'm going to focus on those two first and then get to the other ones. So property, plant, equipment, as I mentioned, land is property. Land is always first. Okay. Land is something that lasts forever, assuming the earth is as old as it is. If you bought a piece of it, it's still here. So in accounting, we look at land as something that can last forever. It's an indefinite. Okay. That's not true for equipment. Equipment has what we call in accounting a useful life. When UPS buys a truck for its delivery, it's going to run that truck almost 24 hours a day, 7 days a week. How long is that truck going to last? How long can any piece of equipment last? Right. That's its useful life. So a company has to decide up front when it buys an asset like equipment or a truck, how long it's going to be useful for the business. That's a useful life. Well, because it's not going to last forever, like land can last forever, it's going to go through a process called depreciation, which simply means a slow way of expensing what we've used every month that we've used it for whatever period of time. So a truck might last several years. A building might last 20, 30, 40 years. So depreciating it is a very slow process of expensing it over a long period of time. So you see that we paid $24,000 for this equipment, and we've already expensed $5,000 of it, which means the $19,000 is what we call a book value. This is the actual book value of the equipment. And that's where that term comes from, book value. Some of you might have did some research on purchasing a car, maybe a used car. And one of the interesting things you might have looked at is what's the book value of this car? Well, this is how they determine it. It's the amount that it's worth brand new minus its depreciation. In other words, how long have you been using up this asset? Because the longer you use it, the more of its value you've used up. The book value is the remaining value of that asset. Okay. Intangible assets, this particular company, Franklin Company, has patents, gets government recognition that you own an invention. So only you can make it. or only you can license someone making it on your behalf. Okay. And then here, this company has some long-term investments. It has an investment in real estate. So again, it has real estate, but it's not using it. If it was using it, it would be property, plant, and equipment. But because they own it and they're not using it, it's long-term investment. Okay. It'll change categories when they start fixing it up and using it to produce revenue. And of course, they have a stock investment. So here you have a debt investment. Here you have a stock investment. So again, these are investments, but in this case, it's an investment in shares of stock, which means you're an owner. And apparently, you're going to want to keep that for over a year because it's in long-term investments. You could have stock investments that are short-term or current assets because you only plan on keeping it for 6 months, right? So the difference between current and long-term is that 1 year mark. Less than a year, current. Longer than a year, long-term. For assets, long-term is broken into 3 classifications. Whether you own it and you're not using it, long-term investment. You own it and you use it, property, plant, and equipment, because it has a physical quality. And you own it, but it's sort of a paper-based quality, proof of ownership, like a patent or a copyright. Okay. Liabilities you're lucky. They're only broken into 2 parts, current and long-term liabilities. Current liabilities. Well, it's again, this date on the balance sheet is important because that's what it tells you. What's current, in this case for a liability, is a debt that's owed within a year. A year from what? From the date on the balance sheet. So all of these liabilities that are listed here, and you've been introduced to all of them in chapter 1, are all current liabilities because they're going to be paid within that year's period of time. However, they actually have 2 long-term liabilities. Again, the word long-term means over a year from the date on the balance sheet. You don't have to guess, you just simply have to measure. Right? So a mortgage is a loan on a property or a building. And so a mortgage is a long-term debt. Okay. And notes payable can either be short-term or long-term, depending on when they're due. All right, so these notes payable here, and it's quite a lot of them, are due within the year's time. Obviously, this portion of the notes payable is due over a year, so it's listed down here. And you're already familiar with common stock, which has no classifications. Okay, it's not broken into anything on the classified balance sheet. It's just stockholders' equity. And you already know the accounts that are there. So again, it's important to know the accounts. Your book explains these with more yet examples. This is a current asset section only from Southwest Airlines. Okay. And again, current assets are always totaled, by the way. Okay. Long-term investments, again, things that are not currently being used. Okay. If it's land or building, something like that, not being used. If it is being used, it's property, plant, equipment. If it's not being used, it's a long-term investment. As you see, Google here has some equity investments. The word equity is synonymous with stock or shares of ownership. So they clearly have shares, they've purchased shares of stock for the long term in other companies. Again, property, plant, equipment, very important classification. This is in every balance sheet you're ever going to see. Okay. And again, they have a physical quality and they have very long lives. In other words, the company's going to be using them for a long time. What's a long time? What's a long term? Over a year. Okay. Land is indefinite. You can use land indefinitely. However, everything else is going to have what's called a useful life. You're only going to be using it for so long before you need to repair it, replace it, or things like this. Okay. And because things like buildings and equipment and vehicles and furniture have a useful life, they are subject to depreciation. Depreciation is a way of expensing the portion of the asset we've used that period of time. Okay. We know how much the total depreciation is because it shows up as accumulated depreciation on the balance sheet. Here is a partial balance sheet for Tesla showing its property, plant, and equipment, and it has a lot of it, as you see. Okay. And again, they also took away their accumulated depreciation. Intangible assets, again, they do not have that physical substance like a property, plant, equipment does, but it's very, very important because the business does need it to do things like a patent or a copyright or a trade name. Okay. And so that's really, really important. This is the Disney balance sheet for its intangibles. All those characters are copyrights. You cannot use a Disney character in anything without the permission of Disney, and that only comes with usually a fee. You might also see that in addition to this company using copyrights on all its characters, and Disney has a lot of characters. Not only do they have the traditional characters like Mickey Mouse and Winnie the Pooh, but they've bought, of course, all the Marvel characters. Disney owns Marvel. And of course, Disney owns Star Wars, so they have all of those characters. So if anyone uses any of that stuff, they got to pay Disney, get permission. Otherwise, they're subject to a lawsuit in court because they're using property of someone else. They've stolen property without permission. Okay. All right. How exciting is that? So one of the things you're going to be doing in this part of the chapter is the chapter kind of breaks it up again. Here's your A and B part, right? So part A focuses strictly on assets because assets have 4 classifications, right? Current assets, long-term investments, property, plant, equipment, and your intangible assets. And so that is basically how they need to be listed on a balance sheet. That's the proper way to classify them. And so here you have a corporation who at the end of the year, December 31st of 2017, is preparing a balance sheet. And these are all the different accounts that you see. And they ask you, well, prepare the asset. Again, just simply assets in this case. So assets are listed first, current assets. So you pick your current assets out. Prepaid insurance, cash is a current asset. Accounts receivable is a current asset. Inventory is a current asset. So you have your current assets. Then you have to put them in the right order, right? So the right order, cash would be first, receivables second, inventory third, prepaid insurance fourth. How you know that? You're looking at a balance sheet. You're looking at the classified balance sheet. They're telling you the order. You don't have to guess. It's right there in front of you, right? There's no long-term investments. That's not uncommon. Property, plant, equipment. Yes, there's equipment. This is how much the equipment cost us. This is how much of the equipment we have used, accumulated depreciation for the equipment. So those two are going to be part of the property, plant, and equipment. And there is no intangible assets to this company. So once you actually have all that classified, you can actually do a balance sheet for them. Current assets, cash, receivables, inventory, prepaid. Current assets are totaled, $7,600 of current assets. Property, plant, equipment is equipment minus how much of that equipment we have expensed through depreciation. We call that accumulated depreciation. So we have $10,700 of equipment that we bought. We've already used $2,700 of that during its useful life. The remaining book value of the equipment is $8,000. So the total assets for this company, $15,600. So liabilities, again, are broken into current and long-term. Again, the word current is short-term, less than 1 year, right? So here is a list of Google's current assets, in essence, that they've listed here. I'm sorry, current liabilities. And current liabilities are also totaled on their balance sheet. Long-term liabilities, again, things that are due after 1 year. I already taught you a little bit about a mortgage being a loan on a building. Here is another one. They have bonds payable. So a bond basically is a loan from investors. There's the stock market, there's the bond market. The stock market is where investors go to own corporations. The bond market is where investors go to lend money to either corporations or governments. So that is the bond. A bond is a loan, long-term loan from an investor. Mhm. Mhm. Right. And of course, there's nothing going on with stockholders' equity. It's always the same. Um, Always these two accounts you have to know for sure. Okay. So then the 1B, this little part wraps up with, now that you know everything about the classified balance sheet, can you classify the accounts as either a current asset, long-term investment, property, plant, and equipment, intangible asset, current liability, long-term liability, or a stockholders' equity account? Or if you see an account and it doesn't belong on the balance sheet, you will see, nah. Maybe I over dramatize it a little bit. Okay, here we go. So here are a whole bunch of accounts that are listed, right? And the job is that you have, and you'll have this for your homework as well, can you classify the account? All right, and you know about those classifications. So salaries and wages payable is, oh, they gave you everything. Okay, salaries and wages payable is a current liability because it's due soon, right? You don't want your employees waiting forever. They want to get paid usually within a week or so. Service revenue doesn't belong on the balance sheet. Service revenue belongs on the income statement. So this is a account. Interest payable, the word payable indicates it's a liability. Usually when we pay interest, it's going to be short-term, current liability. Goodwill is a type of intangible asset that you will learn about in more detail. Depreciation expense. Now, this is an expense. Expenses, like revenues, belong on the income statement. They don't belong on the balance sheet. So this is another account, okay? Because it belongs on the income statement. A mortgage payable, in this case, mortgage, long-term loan, 3 years, long-term liability. An investment in real estate. So they just own real estate, but they're not using it. That's what a long-term investment is all about. Equipment and accumulated depreciation on that equipment are property, plant, and equipment, PPE accounts here. Debt investment, short-term, which means you made an investment in debt, like a money market or a short-term loan to the government. That's current asset. You own it. It's an investment, but it's an investment in debt, which means you're a lender. Retained earnings is an account that goes under stockholders' equity, as it always does. Unearned revenue. Remember, unearned revenue is a liability, and it's a current liability at that. So that's what they're asking you to focus on here for the classified balance sheet. Get to know it, get to know the classifications, get to know what accounts belong where they are, and you should be able to put it all together. Questions?